Welcome to TheoTrade. This is Don Kaufman. You are watching the weekend edition here for January 31st, 2016. We're going to be kicking off February next week. And let's talk a little bit, first of all, about some of the action we saw in this past week of trade and what we're expecting. More importantly, of course, what we're expecting kind of this coming week here inside of trade. And there's a few things that I've picked up on. You know, if you're going to take the time to watch this, I feel it appropriate that I'm going to try to point some things out to you that you probably would not have otherwise kind of found. And one of the first things, again, to kind of quickly recap here. So last week, what we see in terms of movement in markets, clearly, again, since the beginning of the year, Captain Obvious over here, we sold off, right? This entire last week of trade, we've actually been stuck in this range. And there's a range I've been talking about, and it's actually not specific to the SPX. The range I've actually been referencing is specific to the S&P futures. Again, they're slightly different levels. Nevertheless, the levels in the S&P futures are the ones I've been kind of discussing. And to the low side, it's been 1871. To the upside, it's been 1911. We actually cracked through that. Okay, so we cracked through it on Friday. So Friday is this big explosive rally. And of course, you're going to be left wondering now, what's going to happen? Are we going to continue to rally back up? Are we going to go all the way back up to 2000? The first thing you need to know is, again, all right, until otherwise, directed, we're still in the midst of volatility. Don't get too happy-go-lucky over here. These explosive moves, it's what I always warn people. The biggest move you're going to see in the midst of a down move is actually to the upside. And I can't even tell you how many of these evening videos we've recorded where I've said just that. You got to watch getting your head just popped right off to the upside, being short in this, because these things, they get wild, they get fierce in these rallies. Right now, all this is that quintessential, at this point, the quintessential rip ya face off rally that I've talked about so often. In fact, again, the largest moves I've ever seen in markets have actually come to the upside, all right, in the midst of these wild down moves. And it always comes back in my mind when I remember like November 20th, November 21st of all the way back into 2008. In November, there was just the most explosive. There was a 110-point move to the upside in the S&P futures. Seriously, check it out sometime, okay? Back in November, the 20th, 21st over there of 2008, just wild up moves. And they always kind of resonate with me when you see a 50-point move up, almost a 3% move. Kind of, you remember those days. In any regard, first thing I did want to mention over here is in terms of expected moves. So that's always important because, again, when we're in the midst of volatility, what do? Okay? We resign ourselves to just like, I don't know what's going to happen, and you sell premium. It's okay. All right. So how does premium selling kind of work in these, this is a wild move, Don? Well, first and foremost, let's look back at where we were last weekend. So here we were at last weekend, and I went back, Analyze tab into Think Back. I went to last weekend. Okay, why? Because a lot of times I record these evening videos on a weekend, and what date was it? So here we are on the 31st. I went back to the 24th and just looked like the 5-day options. Now look where we were. We were in 1906. Okay, the expected move was just about $50, and I always like to enunciate, highlight, emphasize just this. Okay, did we stay inside of the expected move? Okay, by a long shot too. Like right. So 1906, where did we end up on the week? All right, 1940. So if you're a premium seller, you're a winner. Think about it. Because premium selling the last couple of weeks, it's been the place to be. So now you're going to ask yourself, well, all right, so it stayed in the expected move then. Yeah, but it also did it, in the previous week. The exact same thing in the previous week. Now, we did have one really wild week at the front of the year where we moved almost double the expected move. But again, it's all about probabilities. Probabilities kind of do pay off. With this, we go to the SPX and we look at this coming week's expected move. All right, so we have 5 days to go to the expiration, which of course is Friday. I'm using the weeklies. There's about a $40 expected move. So the expected move has subsided. okay, by quite a bit. All right. So again, last week the expected move is $50. This week the expected move is $40. You're getting 20%, less expectations of price movement. Now again, that can expand, that can contract, but if you're selling premium, you got to realize, okay, the SPX is again producing about a $40 expected move. But that's neither here nor there. Listen, anybody can look on the screen and go, yeah, the expected move, that's great. Okay. The thing that you should kind of focus on is that at this point, this is, again, more of that, rally phase in the midst of a down move. And we need to see very carefully what's going to happen maybe Monday, Tuesday, Wednesday of this week. Why? What I'm going to try to warn you of is that we are still in a very precarious volatility situation. And this is where I'm like, all right, so I don't want to give you the obvious. I don't want to go look at a stock like Google. I don't want to look at Amazon, which got crushed over here. Individual stocks are still not on the forefront of my thinking. Okay, we know that some of the NASDAQ stocks got crushed down. Again, that's the obvious. What isn't so obvious is that volatility is still in what we term a backwardation. So if you look very carefully, the 5-day options are slightly still displaying more risk than the 12-day options, more risk than the what? 18-day options, okay? And then it kind of levels out. But even if we go further out in time, all the way out here to February 20, it's still lower volatility. So as long as you see volatility in this kind of inverted state, which is a form of backwardation, it still means risk now, risk imminent. Okay, and that's exactly what the market's telling you. Okay, but bear with me. Again, anybody can see that in the SPX. Where you also want to be able to see it is, let's go look at the volatility futures. And the volatility futures, it's a little bit different than the SPX. Okay, it's got a little bit of a different time frame to it. But we're looking at the volatility futures, and what do the volatility futures say? They do nothing more than confirm what we just saw in the SPX. All right, so here we have volatility futures for 17 days. And their last trade is right there. It's at what? 21.62 and change. Then we look at the 45-day vol futures. 45-day vol futures, yep. Okay, it's clear. There's still a bit of a backwardation. Not by much, though. I mean, we're only looking at what? Some like 30 cents. But then I took it and I looked a little bit further out in time over here. So we're still seeing, and what this really means is more risk priced in the here and now than out into the future. So then I go, 80 days out, and it's, 21.39. So again, the short duration vol futures are still displaying at this point. Risk is now, risk is imminent, and you got to read into it. But again, let's not state some of the obvious. So let's start to get into and dig into areas maybe that people aren't necessarily looking at. Number one, I go to the SKEW. Now this is interesting because it's not often that I bring up the SKEW, and when I do, I find it's quite peculiar. The SKEW has completely flattened out. So what this basically means is this is looking at out-of-the-money puts versus out-of-the-money calls in the SPX. Okay, and it says the out-of-the-money puts in the SPX normally trade for a huge premium over the out-of-the-money calls, and what that basically means is the puts are expensive versus the out-of-the-money calls. Let's just make that clear. Why are they more expensive? Because people are hedging. They're buying puts, and to finance those puts, they're going out there and selling calls. When the SKEW drops off, and it has dropped off substantially, what happens is those out-of-the-money puts, they're not trading at that big of a premium, okay, to the out-of-the-money calls. Now, why I find this interesting, this is actually the lowest SKEW that we've seen since all the way back here in October kind of time frame. Like, again, almost like, all right, almost unprecedented for this period of time. Now, what you're probably thinking to yourself, I'm like, does that mean people are buying calls? Could mean people are buying calls. But I think more or less what's going on is that traders are actually covering some of their positions out there. And in effect, what can actually happen is during a rally, you can go out there and you can get traders, number one, they can be buying calls in very large quantities. So let's go look at the SPX specifically and see if we can't figure out why is the SKEW kind of flattening out over here. All right, because again, this is like some of the important portion of trade that people have tendency to kind of, go by the wayside. It's missed. So it's just that. If you look at the number of calls versus the number of puts, typically what you see is almost you almost see double the number of puts trading than calls. In this particular case, last Friday, we see a pretty tremendous number of calls trading versus puts. Again, normally what happens on any given day is you see almost double the number of puts trading than calls. So you see lots of calls trading. And in effect, what that's done, okay, is kind of leveled out the skew a little bit. So it's flattened out. You're like, okay, what does that mean for the future over there? All right. It means right now is we've rallied back up, okay, massively. Again, it's the obvious. The skew is flattened out, but the skew flattening out can make a lot of different trades very, very advantageous at this point. Okay, we may be able to go out to sell iron condors. We would like a little bit more volatility. However, the skew flattening out has made it, again, a bit more advantageous to do that. So selling premium on both sides of the market can be a little bit more effective when the skew has kind of flattened out. It's something I'm going to be talking about a bit this week, and we'll actually see how this progresses. My feeling is that skew, okay, and this is, of course, not the skew. This is the SPX, but this skew is going to stay at the 120 level a very, very short amount of time, okay? Because in effect, what I think has been going on and really what caused the skew to level out, as soon as we rallied up, traders were going out there and they were doing what? Everybody that had bought puts over the last couple of weeks goes, I'm going to sell my put, I'm going to sell my put. And it creates what? Offering all those puts for sale, right? Takes volatility, smacks it down, takes the skew, crushes it. Ultimately, the skew leveling out helps us in the midst of what I kind of call reloading. Reloading is just getting ready for another down move. That's really the way I am interpreting the skew dropping off over here, because it's been dropping off for a couple of days. This is, all right, reload. It's reloading. The skew is flattened out. If we start to move down, traders will come back in, buy puts to finance those puts. They'll sell calls. They'll actually throw the skew back up. But the only thing I can really read into this right now is, again, it's kind of that like catch-22, it's hindsight is beautiful, but it appears that this is, again, kind of reloading. They are offloading and selling puts that they had already purchased in the midst of this up move. The next thing I do want to cover, and again, I like to find stuff that's off the beaten path. The VVIX, it's the volatility of the volatility index. It has come way down. Again, could be a sign of reload. Right? When you have the VVIX north of 100, it starts to get pretty crazy out there. When it's north of like 110, it only stays in that range for a very, very short period of time. We're going to watch the VVIX over the next couple of days, because what we want to see, does the VVIX stabilize at this area? Okay, or does it continue to kind of drop? Because this could be a great indication, like, is the market anticipating substantially more risk? We're going to find out probably Monday, Tuesday of this week. If the market is going to say, like, yeah, there's going to be a lot more risk, you're going to see the VVIX come right back up into the 100. All right, so this, again, the volatility of the volatility index, it's just telling you how serious your risk really is out there. And last, but definitely not least, something that I wanted to show you that, again, I think is a little bit off the beaten path that not everybody's looking at, and it pertains to the financials. So the financials, all right, they're not only in a volatility backwardation, but it's still a very substantial backwardation. Look at the 5-day options in here are displaying, again, almost a 30 vol. Okay, then you go out a little bit further in time, and the first thing I ask myself is, like, well, how did that compare to last week? So you're seeing a 64-cent price action for the XLF for the entire week, which, okay, it's not that much. But last week, which is a wild week inside of the XLF, what did it price last week? And if you look, again, I'm on last week. Here's the date over there. And the answer is it was a 70-cent move. It's almost identical. So the thing I've picked up on over here is the market right now is anticipating the risk in the financials, okay, if you will, to be just as large as it was in the previous week. And we saw some fairly wild trade in the previous week. So, okay, until we see otherwise, risk is still completely and totally prevalent over here. All right, this was that, again, quintessential kind of bear market rally. And put your helmet on and get ready for some more volatility. Now, I'd be surprised if Monday, Tuesday, we even see some follow through over here. But you got to remember, traders can come in and they can whack a market very, very quickly after one of these, just explosive upside rallies. You know, another thing, I saw a nice statistic thrown out over the weekend, and it talked about the month of January in down moves. And this is the last thing I'll leave you with. And it said basically since 1950, since 1950, this is the 7th worst January on record. But then it went back and it showed the previous 6 times the market had actually had a horrendous January. It said 5 out of the 6 times the market finished up on the year. And I thought to myself, I go, number one, that's the most worthless data ever, because we only have, 6 previous occurrences to what we're currently looking at. So if you look at a statistical or a data set, like, wouldn't you want like 1,000 occurrences? Obviously, there's not 1,000 years of data to track in here. But, you know, I'm not going to bet my money on the fact that, you know, some statistic says that, well, 5 out of the 6 years finished up. The other reality is, I looked back at some of that data, and one of the years that was really horrendous January was none other than January of 2009. And in January of 2009, the market continued to slide. Yeah, it also continued to get hammered into February of 2009. It only turned around in March of 2009. In the end, sell some premium, get back, get hedged. And that's a lot of what we talk about here at TheoTrade. So to kind of leave you guys over on this weekend edition, a couple of things I do want to cover. We did a class, our very first class here at TheoTrade. And if you haven't found it before, it is in the members area under the archives over there. It's under the class archive. So it's up there. You can download my slides from right on here. So you can download the slides over there. It's 2 hours and 21 minutes. Obviously, a lot of unexpected move. Probability. Nevertheless, surviving the extreme volatility, that is the first class we've done. The second class that we're going to do, it's coming up February 13th. Get ready for it. The other thing is, officially, TheoTrade is coming out of beta. I want to thank every single person that kind of helped us throughout the course of this beta. We launched TheoTrade January 4th. Here we are, January 31st. We're about to go. It's real now. So it's real. If you do want to be a member, you have to enroll for the membership over here. It's under the Total Theo Special. The Total Theo Special, we pulling this down Monday afternoon. The Total Theo Special, I just want everybody to realize there's so many questions that have come in the last couple of days. You can sign up for a month. You can sign up for 4 months. You can sign up for 12 months. There's no contracts, nothing. Every one of these memberships gets the exact same thing. You get all the classes. You get the nightly videos, the coaching sessions, the live trading chat room. We're doing Wednesday coaching sessions. Sometimes we'll have a Wednesday class. Sometimes we have a Saturday class. In fact, February 13th is going to be a Saturday class. You sign up for any of the memberships. And it's completely up to you. Just know that whatever membership you have access to the archives, the nightly video. Again, everything is in there. We are offering these kind of introductory prices if you want to go for like a year or 4 months. Those are the ones we're going to be pulling off the site come Monday. You can always enroll for TheoTrade at $99 a month. No contracts whatsoever. I just wanted to make that abundantly clear. Again, it's found regularly on our homepage over here under Total Theo Special. Click on it. It will be there. Thanks a lot, everybody, for joining us for the TheoTrade beta. And officially tomorrow, February 1st, we go just TheoTrade, no longer in beta mode. Thanks a lot, everybody. Have a great weekend. Bye-bye.